Welcome to America's Commercial Real Estate Show, your source for market intelligence, forecasts, and success strategies. Hi, I'm Michael Bull. Thanks for being with us. This segment is brought to you by arborcrowd.com. If you're looking for professional crowdfunding, check them out at arborcrowd.com. Well, today we're going to talk about medical office buildings, and I love the sector. I love the safety. It's as my head of medical office space says in my company here, it's just like office, but it's more complicated. And we're going to talk about some aspects of the medical office buildings in the healthcare space. Please welcome my first guest is Jim Costello, and Jim is Senior VP with Real Capital Analytics, and he's joining us from New York on Skype. Jim, thanks for being with us.
Thanks for having me here today.
So let's talk about the medical office market. It seems like when we market properties, we have multiple competing offers. Seems like a lot of people are looking for medical office buildings. What are you seeing for volume out there?
Yeah, that comment that you're seeing multiple offers, that doesn't surprise me because it's the only segment of the office market broadly that has been seeing growing deal volume in 2018, up 20% year over year in May and up 14% for the year overall. That's totally different than the rest of the office sector where we're seeing declining activity.
And what do you see for cap rates? It seems like of the deals I look at and that we do, it seems like you get a little bit better yield and cap rate on these medical office buildings than you do regular office. Yes,
you're getting a better yield. It's in the low 6 range. And part of that, it's kind of tied more towards suburban assets overall, in terms of the location of most of the medical office buildings that are on the market. And so it's just tied up with the higher cap rates that are in most suburban locations. But there is sometimes a little bit more complexity with these assets as well, as one of your guys there noted. And so investors are going in for those higher yields, and given that there is some complexity tied to it. So it takes an operator who understands those complexities to actually earn that yield.
Yeah, and it's nice, I think, because one of the aspects that I really love about medical office is the tenants typically like to stay a long time, right? They don't want to move around. So what are you seeing for cap rate trends, Jim? Are you seeing any change there in the MOB space?
Yeah, it's funny. Cap rate trends, a lot of folks have been coming to me thinking that, hey, since interest rates have been on the way up, shouldn't those cap rates be moving? But they've been mostly flat over the last year and a half. And I think part of the issue is that there's, first of all, not a one-to-one relationship between cap rates and interest rates. As interest rates go up, cap rates may not move. The spread may narrow. And the spread may narrow if investors see an income growth opportunity for an asset class. And for medical office buildings, people understand that we have an aging population in the United States. And that aging population is going to need a lot more medical care. And that's an element that I think drives investors to look at the sector on the expectation that you're going to get some better income opportunities out of the sector.
Yeah, I think that's an interesting point. If you look at all the sectors of commercial real estate and you said, hey, what's going to be impacted the least with the rising cap rates? What's going to be impacted the least? You kind of look at healthcare or medical office buildings and you think, well, with these baby boomers really getting of age, there should be a lot of demand increases. And would you think it would have the least rise in cap rates as interest rates climb? Does that make sense?
Part of the issue on the rise in cap rates is expectations on the income side. Eventually, when that happens, that would be part of it. The other thing is what happens with financing of assets and how lenders react, and that gets tricky as well. So it's a complicated web there. Apartments have a different type of funding on the debt side than all other property types with the GSEs. So I think anything kind of apartment related may feel a little bit less of a cap rate increase. But the other property types where there is a growth story in place, I think will have a little bit of a muted impact on cap rates. We've seen that in the retail sector with that single tenant net leased space. We've already seen cap rates move up in those assets in the last year and a half because of the interest rate increases we've already seen. And there it's going up because, number one, it's retail and there's a fear around retail. But then with that inflation kick and with the interest rate growth, there's no additional room to grow income for these assets because you have a fixed lease payment over time. And so just there hasn't been as much of an opportunity to adjust those. And so to the extent buyers are going into there, the cap rates have been adjusted a little bit.
Yeah, we're seeing the same thing here in the field, moving single tenant net lease properties. We're starting to see those cap rates rise already, and we're seeing the same thing in the MOB sales, that it's been a little flat with still a lot of demand, even though maybe the cost of financing is going up slightly. So what would you guess, Jim, 2 years from now, let's say a 7 cap medical office building, what might the cap be in 2 years? I know you have a crystal ball there in New York in your office.
Yeah, crystal ball. I think that there's going to be pressure on cap rates as interest rates move up. The spread has narrowed between cap rates and interest rates, but it's narrowed to a point where you're about at the long run average for that spread. So from this point moving forward, as interest rates move up more beyond the 3% range for the 10-year, I tend to think that you're going to see cap rates bear some of the pain of adjustment from this point forward. It won't be 100% of the change. It can narrow a little bit more, but I think roughly half of every increase in the 10-year Treasury may come down to the change in cap rates. So that means that if you have an additional 100 basis points of 10-year Treasury increase, maybe additional 50 basis points of cap rate increase.
Okay, well that sounds reasonable. And when you're talking about an $18 million or even an $8 million building, that could be a significant change in the valuation. So what are concerning to medical office building owners? Well, what's positive or negative that investors in this space are thinking about?
Yep. Positives and negatives there are actually that point I was talking about early on. Yeah, there is a yield opportunity, but the management expertise around the building, that matters. Yeah. It is an office building, but it's more complicated. I'm going to steal that line. It's a great one. But that complicated part can eat into your expense and both on the operating expense and on the capex side in ways that, if you're not prepared, can really remove the benefit of that high yield.
Yeah, I think you do want to be experienced, or maybe partner with an experienced a company if you're investing in the space. So, but as you said, it's kind of a positive sector with all the baby boomers coming of age, right?
Yeah, and as the baby boomers come to age, there is additional demand for those services, and that's impacting investor perceptions of the senior housing sectors as well. And that's another one where you have tremendous interest as people pursue that demographic play. The thing I think they all have to be cautious about is what is the horizon that you're looking at for the investments, because the baby boomers, they're not the largest labor part of the labor force anymore, and even the senior care and the medical office needs that they have, eventually, that won't be the demand from this group anymore. So you have to look closely at the age horizons. It's not going to happen next 2 years, 10, 15, 20. Those are the kind of things you have to be thinking about.
Yeah, well, that's a good point. I'm a broker, so hey, we'll sell it in 2 years for you. Don't worry about it. Well, Jim, what would you leave our audience with related to medical office space, medical office buildings?
The medical office sector is one sector that's been defying the trends for office overall. You've seen positive growth in volume for both the month of May and for the year overall. And it's not just positive growth. a lot of property sectors starting in 2016 had a bit of a swoon in deal volume from the 2015 highs. The medical office sector experienced that swoon as well, but it got back on track, and deal volume has been pushing up higher than where it was even in 2015. And so it's one sector where there is, people see some legs.
All right, very good. Jim, thanks for joining us. Great information as usual.
Thank you.
If you'd like for more information from Jim with Real Capital Analytics, their website is rcanalytics.com. Stay with us. We'll have more on healthcare real estate and medical office buildings. I'm Michael Bull. This is America's Commercial Real Estate Show.